The S&P 500 crossing the 5,000 mark. What does it mean? I'm Lisa Bernhard with Reuters, and here to answer that question is Adam Coons. He's Chief Portfolio Manager at Winthrop Capital Management. Adam, as you and I record this, the S&P 500 looks poised to close above the 5,000 mark for the first time ever. What is the significance of this?
Well, I mean, first off, there is a psychological part of this. You know, we like milestones as humans, so I think to see this and to see the S&P, get above this somewhat arbitrary level, but we put meaning behind it. So yeah, I think to see such a large number, round number, we tend to use that as a milestone, especially in markets. Sometimes it can be a resistance. And I think we've seen that, here the last few months. But now that we're past this, 5,000 mark, we can put on our 5,000 hats and then tomorrow will just be another day. But it does have a psychological impact to see that kind of number.
So what is driving the S&P higher today?
So fundamentally, what's driving the S&P 500 higher and above 5,000 is largely driven by the revision we got today on the inflation number. So CPI original was 0.3%, but it actually was 0.2. Not a huge difference, but what it really solidifies is the market is very responsive to any data point that helps the case that the Federal Reserve can cut rates this year. So seeing inflation accelerating at a slower pace than originally thought helps make that case that the Fed can lower rates at this point.
One gainer that we're seeing today is Nvidia, and we've watched that stock soar, right? A very expensive stock. There was a Reuters report out today that the company is making a unit to design custom AI chips and cloud chips. These are different from the general H100 and A100 chips for the chip experts out there for AI products. As an investment advisor, when you see news like this coming out in AI, how do you respond? Do you buy more into the stock, the very expensive stock? What do you advise clients? How do you respond to this?
For us, what we're advising, we've held the stock through this. It's a great company, an even better stock to own. But at this point, with the valuations where they are, we are actually selling, trimming the position, taking chips off the table, if you will, because you've got a stock that has, it is rocketed up. And so at this point, we feel more comfortable just taking some of that off because now it's turned into more of a narrative and momentum stock, less fundamentals behind stock price. So when we start to see that, we do want to start to reduce our risk. Right? So we're not selling it outright. We're just taking some of those gains that we've gotten and redeploying them. There's other places we see in the market where we could put money. Still like the stock, still like the company and where they're headed. We do believe in the AI story, but we just think right now the AI story is really a narrative-based investment theme, and there's not a lot of proof about what the monetization of it can be. So that's just why we're a little bit cautious here in selling.
So that's interesting that you're actually trimming your position today. The other mega cap tech stocks are up, and Microsoft could close over the $3.1 trillion market cap. To mention another milestone today, I think would be the first company ever to do that. Are you also trimming back on some of the other mega cap tech stocks today?
Actually, no. So I still like Alphabet and Microsoft for different reasons. We're staying in those stocks. And really what it comes down to is Nvidia, they're all about AI. That's what it's got to be for them to make money in the future. They're going to have to innovate. They're basically, in order to justify the valuation, they've got to come up with things that, as an investor, we're just taking a guess on. We don't even know what it's going to be. When I look at Microsoft or Alphabet, I don't have that story. Valuations are a little bit rich, I would say really right on fairly valued. But these are, robust companies with multiple revenue streams that, can weather a lot of storms. They're, low debt, tons of cash flow that they can reinvest into other projects. So that's why we still like those stocks. But we're definitely more selective in the, when you're looking at the Mag 7 per se, we're not buying all 7.
Got it. Okay, let's turn to one of the big losers today, and that is Expedia. The stock has really taken a nosedive today post earnings. Now, there's been lots of talk about how consumers are spending money on experiences, and travel is an experience. So, what happened at Expedia?
Yeah, I mean, I'm going to go back to the inflation number, with it being revised down. When you start to see disinflation or the cooling of inflation, that comes from one thing. That's people spending less. And what you're seeing here with Expedia is just that. The consumer is tapped out, frankly. And we've been saying this for a while. We're wrong in some ways because it's taken longer for it to really affect markets. But I mean, when you look at the consumer, savings rates are back at all-time lows. Credit card usage is at all-time highs. You've got the student loan payments kicking back in. So just the levers that the consumer can pull to keep spending, they're running out. And I think that's where you're going to start to see this more and more through the next couple earning seasons, where you're going to see revisions down.